case 459, candle that closes, and the final print on that candle comes in at 18,558 even. The very next candle at 6 o'clock, because of our delay where markets are not trading, we open up, and that's the opening price down here. Okay, so that opening price, which you can see at the top of the chart, is 18,550.25. So between the difference of where we closed at the 5 o'clock hour and where we opened at 6 o'clock, that is what? That's your new day opening gap. And since we opened lower than where we closed, that means we have a discount, lower opening. Is the difference between this close and this open greater than 20 handles? No. It's literally less than 10. So am I going to draw a line in there? You can. If you want to have them on your chart, there's nothing wrong with that, Caleb. But if you are going to follow the rules that I'm teaching on, you really shouldn't need to see that line. Your eyeball should say, okay, well, right about in here, that's about the middle or consequent encroachment. And then if you can eyeball that, then you can eyeball half of that is the upper quadrant and the lower quadrant. And it's just a matter of doing it. Okay, you don't have to have every single line on your chart, because otherwise it's going to be a lot. And you don't need a lot. You just need one or two elements to have in mind where you think the price is going to gravitate to or gyrate around. And based on, like, for instance, we have the economic calendar today. If you've already done your homework and noticed that today there is no medium or high impact news events, none. It's Friday also. We've had a large weekly range. And we'll talk about that for TGIF purposes before we close as well. So when we have this in here, we're waiting for the market to do what? We're waiting for the market to create motion around this new day opening gap. Do not trade initially. As soon as you get the gap noted here, you're not in there trying to trade off of it. Why? Because there's an element to time that has to be referred to first. Because as I mentioned and ad nauseum, the markets will not move until it's time for them to move, which is algorithmic. Yes, price will gyrate. They may have meaningless, aimless little movements, okay, that I'm not interested in. But when time is now introduced as the factor that's greatest importance, that means at 7 o'clock to 9 o'clock, that's your Asian session. You can use this new day opening gap now and build it around the element of liquidity. So what does that mean? Well, if you look at how we have the market work and gyrate around, I'm going to maximize just this chart. I know you're over here looking at this stuff like it's some kind of secret weapon. We're gonna have all these lines amplified on the chart. I'll show them all to you, and most of everything that you've seen all week long. Nothing's been added except the new day opening gap that was formed for Friday's trading last night at 6 p.m. Eastern time. There's nothing else over here, so stop looking over here or here. Well, it's the same lines you've been watching all week. But I'm going to maximize this chart here. And I want you to see what we have done. We created a high, and then we had created another high. So what is this high here in relationship to this one? What is that, Caleb?
Relative equal.
You're gonna speak up.
Relative equal high.
Okay. So we annotate that. So above this high, there's liquidity in the form of buy side. You want to be annotating that so that you're going to be taking screenshots of these types of things. After it's happened, you start like this. You don't try to predict them. You're trying to avoid, I need to put this to work right now and see if it works right now. No, you're studying it after it happens. And then you do a walk forward where you're watching price without any button pushing, without any kind of hard opinion. But you're doing it with the expectation of collecting experience watching it. So you're going to be doing it on the top and the left, and that's how I like to annotate mine. Okay, so now we have the market that opened at 6 o'clock. We traded above, short-term high. You can annotate that as a minor buy-side liquidity pool. It drops down, takes out this low. You can annotate that as a minor sell side liquidity pool. But what you're waiting for is you want to see price do two things. You want to see it leave the new day opening gap. You want to see it cross over it and go below it. When it goes below it, you don't want to see it just trade below it for the sake of going below the lowest low of it. You want to see a short-term low taken. It does that. See that? So what has it done? It set an initial range to build and engineer liquidity. You don't even need to see this one yet. But what we're doing is we're seeing how price, and I'll annotate it here for you. That high, and let's change it to black because I want it to be different. And we'll do this. That's not what I want to do. If you hold down Control and click on the line or thing that you want to copy, don't do it on the little button here. You gotta do it somewhere over here, and then drag your mouse away from it. It'll copy it for you. I learned that from my students, by the way. Most of everything I learned on TradingView is all from students. So this is a little minor. That's a minor short term. So it would look like this: minor short term buy side. And you make that real little. And again, on the top left. Okay. And the same thing with this down here. You're going to hold down Control, drag from the middle of the line. It'll copy it. And you put that right there. And drag it through a little bit. And now you want to make sure that that's underneath it. So it's below. So bottom left. And you want to change it to sell side, because that's what's below old lows. Sell side below it, buy side above it. Okay, so what that does is it helps annotate your chart, and when you refer back to it, what I'm doing there is I'm holding down Shift. That way I'm keeping the line straight. And it keeps everything nice and neat. You might want to make that font and text size larger, but for me, I like that because I don't want so much attention drawn on it. I just want you to know that these are the types of things I want to see in your chart around the openings, okay, or the times I'm teaching you to focus on, like the 7 o'clock in the morning, the 8 o'clock in the morning, the 9 o'clock in the morning session. Since that's your time, you're going to be looking for the same event there, okay? So this is amplifying what's already been taught in this week's live stream, but I'm applying it to this time of day for the folks that can only trade this time of day. They may not be able to do what you're going to be doing or trade at all except for this time. So this is Asian session trading. This stuff works for Forex too, so don't think that it's just a one-trick pony for indices. This is exactly what you'll be doing, the same thing in Forex. Okay, I don't trade crypto. I don't know. I've never investigated because I don't care to trade crypto, and I'll never do it. So I know a lot of people are still asking about that, but we have a short-term sell-side liquidity pool below here, and we have a short-term buy-side liquidity pool here at 6 o'clock, and then we have the new day opening gap. So we have new day opening gap, and what we're watching at that very moment is you want to see it trade away from it, which it does. Is it going somewhere randomly? No, it's just going in here to do what? It sets an initial range for building and engineering liquidity. That means now there are going to be buy stops that form right above this high. So this is what you're going to have in your chart. And on the bottom, down here, and some of you are like, man, this is a lot of stuff to be doing, and I ain't making money yet. Well, if you don't want to do this, go trade indicators and check back with me in 6 months and tell me how you're doing. I know you'll be watching these videos. And I'm going to stretch this out just a little bit more because conflicting. So now we have that on the wrong line, sorry. That's where it needs to be, right here. So what we've done is we've taken out this short-term low, and we created an initial sell-side liquidity pool, and we went above this short-term high, and we created an initial buy-side liquidity pool. Okay, why is that classified like that? Why am I labeling that high, and why am I labeling this low? And why is it initial buy-side and initial sell-side? Because we've opened a new day at 6 o'clock. We created the inefficiency that is the new day opening gap. It's moved away. That's the first thing we're looking for. It needs to move away from it. It does so. What is it going to do? It takes out the short-term buy side. Does it go back down below the new day opening gap? Yes. Why? Because the algorithm is calibrating and setting, and this is visually representing how the algorithm engineers liquidity. It takes a short-term pool of liquidity out and then goes to the opposing side below this low. Now there's a new low and a new high after 6 o'clock. You see that? This is the initial high and the low that every trader that trades at that moment is going to refer to for where their stop loss is going to be. So this is no longer a factor. So while that's important to have on your chart for the purposes of learning, you want to kind of like keep it muted. Don't have it so prominent in the chart. And the same thing down here. But you do want to have it initially as a screenshot while it's doing this. When it runs up here like this, when it does that, screenshot it. And then later on, if it rolls down and take out that low, screenshot it again. Because you want to see these screenshots as they go to the levels of interest. Like this, it should do that. Now, what happens if it did this? If it was in here and it went down there first and it took out that low? Okay, you would screenshot it as it happens, and then you would anticipate it running above this high. And what you would do, classically, it will do that. There are times when we start the new day at 6 o'clock, and it'll just dilly-dally around and do nothing. And it won't even bump above or below. If it doesn't do that, don't worry about it. That's typically telling you that Asia is going to be dull. It's not going to do anything. And it's probably a good day for you to just go watch a movie with your spouse or go exercise and then go to bed early and get rested for your workday tomorrow. But you want to be doing things with a purpose of knowing that it's going to fit the characteristics that are synonymous with the market making a sizable move that's predictable. And if it's just real lethargic and lackluster at 6 o'clock and it doesn't really do anything going into 7 o'clock, because that's your key time, 7 o'clock starts the Asian session. And you think it's just Forex. No, these markets are ran through artificial intelligence. And sometimes they're tweaked a little bit manually to cause a little bit more excitement or to disrupt something. Okay, so now we have initial sell-side liquidity for the day and initial buy-side liquidity for the day. Outside of those two reference points, then you look to the left and say, okay, where are the larger pool of liquidity? Well, obviously it's here. So if we have that, once we broke through here, we have to see it do another characteristic with the new day opening gap. We have to move away from it initially, go to a short-term high to take liquidity out, which it does here, and then drops down below, crossing over the new day opening gap. So this is where you want to see it coloring outside the lines. Okay, so many times I've introduced ideas and talk about specific PDA arrays, and when I tell people annotate this level, annotate that level, this is a fair value gap, this is an inversion fair value gap, this is something else. And as soon as someone that's watching it sees it cross through, they think, aha, it didn't even hold. He thought, you have no idea what the fuck you're talking about. You have no idea what you're talking about. And this is the stuff that pisses me off, because they can't wait to do the, I gotcha, I'm going to go on social media and see what ICT did here, did it wrong, and then try to make videos and bullshit. This is the logic behind it, okay? You want to see it trade away from the new day opening gap as it formed. And if it goes up, it's taking a short-term high out. And then you want to see it cross back over it and seek a short-term low, which is what it's doing here. Once it does that and it crosses back into it again, we have now set initial buy-side liquidity and initial sell-side liquidity. Now you're going to wait. What are you waiting for, ICT? When's the time of day for Asia? 7 o'clock. Okay. Go over here to the vertical line. Does this seem complicated yet? Let me know Let me know if this is complicated, okay? Because this is really simple stuff. Really, really simple stuff. So now we have what happened. The market crosses back above new day opening gap. Does it take out the low here, right there? As we're heading into 7 o'clock, what is it doing? Is it moving to this low to challenge this sell-side liquidity?
Absolutely not.
So what is it doing here energetically here? What is it doing?
And it is placed on the upside.
Right. So it's crossing over the new day opening gap. And then at 7 o'clock, what does it do on the 7 o'clock candle? Look close. Let me take this away for a second. What do you see it do?
And it dips back into it just slightly.
It retrades to the new day opening gap that was formed right over here. You see it touching that?
Sure.
So if it's going to go back to that after having displacement here, it's already set the initial boundaries for the sell stops and the buy stops. So the algorithm is giving the signal right here. Now we're inside the element of time, Dave. So the market should displace above this high, relative equal highs, challenge the initial buy side liquidity, and will test and hold to see if it can run above this high. Now, you know, because you sat with me last night, we actually did this. We actually traded it. We pushed the button, and there it is. But I'm going to show you the logic behind it, so that way you, as a individual that wants to trade the Asian session, this is the protocol, this is the guidance, this is the step-by-step, this is what you do, this is all you do. Every single day, you're looking for these signatures, these characteristics. If they don't do these things, guess what you don't do? You don't push a button. You don't trade it. You don't have high expectations, but you still study it. Is that clear?
Yes, sir.
Okay. Not that you're going to be trading this time of day, but I have to make sure that it's the same way for you when you're doing it in the New York session. So at 7 o'clock, you're going to be studying and looking at price to do these same things. So if we look at how the price opens on this candle, it drops back down and touches and retrades to the high of that new day opening gap. So everything's in motion. Everything is set. We did not have an interest in going back below the initial sell side liquidity that took out this low. The key things are this. We're gyrating around the new day opening gap. You want to see this. But when it comes to time, 7 o'clock is your time in Asia. The algorithm will come online, and you'll see buy programs and sell programs begin right at 7 o'clock or just after it. Okay, and you're only really interested in until 9 o'clock. So if you're a working class hero in the United States, or if you're overseas and you want to trade in this time of day, your key times are 7 p.m. New York local time to 9 p.m. New York local time. So it's a small little window of focus. You don't have a whole long, it's not 4 hours. It's a very small segment of time. And I want you to go through your charts, and I want you to annotate these things, not you, Caleb, but everyone else that may have an interest in this. Even if you don't want to trade this type of or time of day, it's beneficial for you to log this, because you're going to see things that will further prove that the markets are algorithmic, and they're operating on the things I'm teaching you that they do. Okay, so anyway, the down close candle in here, it trades down, touches the top of the new day opening gap, and now because it's 7 o'clock, it's proven that it's not going to go down here. It has no interest in it. And this run here, this right here, that is indicative of that it wants a run. So because it's doing this buy side imbalance, sell side inefficiency, I would have no interest, as you saw last night. I'm not interested in seeing it come back down into that gap. So what does that make this gap? It makes it a breakaway gap. And so if it's going to break away from running higher and not going lower, what's it going to seek? This short-term high. I want to see, does it have momentum and speed in which it takes that relative equal high out, this high and this high. When it trades there, which it does right there, it pops through it real quick and then comes back half of this range, consolidates around it, boom, runs into initial buy-side liquidity. So now I want to see this treated as rocket fuel. You ever see those guys that have their funny cars and they have nitrous oxide? You want to see the nitrous oxide button pressed in price action right when it does that. You don't want to see it go up and then go right back in, because what that was is it's a fade. That's your turtle suit. It's a fake out. What we're looking for is we want to see like a nitrous oxide injection of strength, speed. When Dad does the recordings when I'm trading, and I'll type out and say, I want to see speed and magnitude. I want to see distance. That's because I'm expecting these elements in price action. At that moment, I want to see that being visible in price. And you can see it happening here. And then we gap up. Where this candle closed, it gapped up here. When we trade back down into that, right there, that is an entry as well. And you'll see those things as we start going to the charts live. I'll point them out to you. And when we take screenshots, this is an actual wonderful buy. And then we start to roll up here. Then we see the classic volume imbalance and retrade to it there. And that's another buy. And then you have this big pop here, which we watched happen. I mean, we both were like, yeah, when it happened, it's like, yes. Well, it runs up there and took the buy side here. So visually, you can see how in this candle, I'll put that right over top of it. You can see the entry right there. And what I was aiming for, as I wanted to watch when it opened and traded down, I wanted to see it get below the body of that down close candle. I don't care where in the spectrum of that wick, because that's a discount wick. I'm buying that order block because I understand it's an order block. Everybody else will simply say, well, you got to look to buy the down close candles. And that just shows that they only listen to my very first introduction to an order block because they don't understand what an order block is. So I want to be in the discount element of that down close candle, and I want to be entering below its body. In this case, it's the close. So if you look up here in the upper left-hand corner, you see the close. It says 18,560.00.
Yes, sir.
I want to be buying below that, at it or below it. And my entry was 559.75. So that's pretty good. And then it rallies. And when you have this break like this, your stop loss has to be below the consequent encroachment of the new day opening gap, which is what what you watched me do last night. So for the folks who are saying, well, where would your stop loss be? Because we gapped up like this, and we've already done this. Watch what we've done. We've opened here. We created the new day opening gap. We took short-term liquidity here, took short-term liquidity here, and then we crossed back over top of the new day opening gap, and then crossed back down below it. And then now we have this displacement ahead of 7 o'clock. You see that, folks? You see how that element of just, it's letting everybody know that sees price with this understanding. You're not supposed to know this. I'm not supposed to be teaching it really, but these are the little hallmark signatures that, okay, it's about to happen. So now we have to reference these completely random levels, the new day opening gap, something that's been renamed and revamped by somebody else that nobody has an identification on. Nobody's there to pick the $5 million up for me having been exposed as this is where he copied it from. Wyckoff has no idea what the fuck we're talking about here. If he was, he'd be my student. This touch of that high of the new day opening gap, that's your trigger. But I want to get in there right as it's trading back to that wick, which we're going to talk about wicks as gaps today also. The market has immediate feedback and tells me I'm on side. I don't need to worry about anything now. And as soon as we take out this high here, the stop goes to break even, or at the very minimum, it has to be at the top of the new day opening gap. And you don't chase it. You didn't see me rush my stop loss. I mean, you just relax and let it happen. So the market gives us two qualifying, comfortable, like consoling, like it's okay. Don't worry about it. It's coming because we see the displacement here. And when we see the displacement, every displacement does not have to see it trade back down into. It's better for your trades to not see them return into buy side imbalance, sell side inefficiency at all. That's what you really, really want to see. Okay. If it has the interest to go back into it, that is indicating that if the move's coming, it's being deferred, and you're gonna have to sit through a period of uncomfortable waiting and maybe a little bit of drawdown or chopping it around before it takes off. I don't like those types of trades, which is why I like to look at the market when it creates these types of characteristics, where it's really indicating that, hey, it's about to pop, and it's doing exactly what I want it to do. We can time it because the market operates on time, not price first. It's time first, and you have to know what these elements of time are and why they're a factor. Otherwise, every Mickey Mouse bullshit indicator or even my stuff applied at the wrong times isn't going to work. So you have to have these elements of time determined ahead of time, and it has to be your central focal point for your model. And if you can't arrive at that as, okay, that makes a lot of sense, then you're going to struggle. You're not going to have any success with this. You're going to think it's all contrived. As much as I keep showing it and proving it, it'll still just be he's lucky, or it's just, it just happened to be randomly in his favor that day. And it's, anybody can make excuses for not wanting to do it, but no one can make an excuse and say it's random, because it's absolutely following the logic that I've been teaching for decades. So there's our entry, and then we want to aim for something above this buy side liquidity pool. Because if we know that it's likely to trade up above it, how can we arrive at a target that is close to it? Well, what was the leg of price prior to this run up that's going the other direction? Can you see it's this high down to that low? So in other words, we had this movement kind of like a slingshot or a catapult. Price is winding back, and then it takes off and runs for it. You see that?
Sure.
So we can take this price leg here to that low, and we can get some measurements to get a baseline for range finding. So if I'm interested in a run that goes above this high here, okay? Once we have indications that we have this high taken out, which is what we get there, that's the second qualifier that really builds the confidence that this trade is going to be a runner. In other words, you should have no anxiety at all about the trade not panning out, because we had this ahead of time, right, going into 7 o'clock. We already worked above and below the new day opening gap. We kept initial sell side in play there. And now we refer back to this one. So this is the buy side. So that's where your initial interest is. Do we have the momentum and interest to power through that? Because it could have very easily done this. It could have went above it and then started to break down. And that would have been just simply a losing trade. And there's nothing to be afraid of with that. But it's not likely to do that if you have something like this, where it starts running energetically, proving that that low is now not interested to take out that low. And now the buy side here and here and here is where we're focusing on. Because the Johnny come latelys that didn't trade yesterday and they weren't bullish, they're trying to get on board. They're trying to get on board because now the market started trading at 6 o'clock, and they're trying to buy anything that gives them a reason to be long. So I want to capitalize on that and know that any rallies that it forms is going to be short-lived. So I have to know beforehand, where are my exit points? So how far can it run up above this buy side liquidity? Well, we're range finding by taking the fib from here to here, and all we're doing is measuring the distance between that low and that high, and then duplicating it, okay? Going up one measurement of that and then a half, which is why we have that standard deviation there of that's negative 1.5. So what that is this range from high to low times 1.5. So you get a baseline. In other words, let me show it to you like this. If I do this and show you just negative 1, what that will be is a perfect measured move. So in other words, it's from the low to this high. Perfect duplication added to this high would be here. Okay, so that would be a good place, to take a partial. If we had more than one contract on, we could have took a partial there and had a limit order to sell there and then aim up here. But because of this idea of this is where it can color beyond my expectation of just going above that high, then this is one standard deviation. So what I do is I like to find the midpoint between that. So if I do something like this, I'm just going to eyeball it real close, okay? If I know that this is where the midpoint of both targets are, so if